Welcome to The Explainer. Okay, today we are diving into what is quite literally the biggest initial public offering in human history. SpaceX has officially hit the public markets under the ticker SPX, and man, it has wrought an absolute tidal wave of excitement, speculation, and just massive numbers with it. But, as we often find when we dig into the mechanics of Wall Street, what's happening on the surface doesn't always match the gears turning underneath. So we're going to cut right through the noise today. We're looking directly at the public documents, the company financials, and the heavily engineered structural mechanics of this IPO. Let's jump right in.
I mean, on day one, the hype was absolutely deafening, right? You probably saw the headlines everywhere. SpaceX raised $75 billion in a single day. The financial news networks were practically throwing a parade. But when we take a breath and step back to look at the underlying math, a pretty sobering reality emerges. We really have to ask ourselves, who is actually buying into a $2 trillion valuation for a company that is fundamentally unprofitable right now? To understand the answer to that, and spoiler alert, it might mechanically include you, we need to look past the rocket launches and examine the cold, hard structural facts.
All right, Section 1, the $2 trillion pop. Let's break down those dazzling numbers everyone is seeing on the news. $2 trillion. That is the number that basically broke the internet. A $2 trillion valuation on day one. To put that into perspective, the stock jumped 19% on its first day of trading, closing at $160.95. That valuation makes SpaceX worth more than the market caps of Coca-Cola, McDonald's, Disney, Nike, and Starbucks combined. It's an incredibly powerful story of human ambition, and hey, stories definitely move markets. But when you're evaluating a company objectively, you absolutely have to separate the story from the spreadsheet. And honestly, the spreadsheet brilliantly illustrates the disconnect here. SpaceX is currently trading at a terrifying 94 times its revenue. Think about that for a second. You are paying $94 for every single dollar SpaceX earns in sales. Just for context, when Meta went public, it traded at 22 times revenue. Amazon was at 18 times. The highly respected research firm Morningstar actually ran their own detailed valuation on SpaceX and concluded that the fair value estimate is closer to $63 a share, which values the company around $830 billion. That is a massive gap from the $160 trading price. The current valuation essentially assumes the company's future earnings are going to grow 75-fold over the next decade.
Moving on to Section 2, the XAI financial black hole. So what is actually happening inside the business to justify or maybe contradict these numbers? Let's expose the massive financial anchor that's currently dragging down the broader company.
Look, most people completely misunderstand what SpaceX is. It's not just a rocket company. It's practically three companies stacked on top of each other. The famous launch business, that brought in about $4 billion. But the real money printer is Starlink. Starlink generated roughly $11.4 billion in revenue in 2025, and it's operating with incredible 63% profit margins. They've got over 10 million active subscribers across 150 countries. It is an absolute crown jewel of a business.
But here is where the math gets really complicated. You have to contrast that highly profitable Starlink operation against the February 2026 all-stock merger with Elon Musk's artificial intelligence venture, XAI. When you stack the cash-printing Starlink and the solid launch business right next to XAI, the picture changes entirely. The consolidated company actually posted a loss of nearly $5 billion for the year on roughly $18.5 billion in revenue. The AI division essentially wiped out the profits of the other two segments completely. So the crucial point we need to focus on is this specific number, $6.36 billion. That was XAI's operating loss in 2025. It is a massive, relentless cash burn. Following the departure of its original co-founders, it was publicly admitted that XAI required a complete foundation rebuild. So, at a nearly $2 trillion total valuation, investors are essentially buying a cash-printing satellite business that is handcuffed to an AI lab, lighting over $1 billion a month on fire.
Which brings us to Section 3, the 180-day lockup trap. Now let's look at how the stock is actually engineered to trade, because there's a mechanical trap set by insiders, written plainly in the prospectus.
Now, what's really fascinating here is the hidden performance trigger. In a standard IPO, insiders are locked out from selling their shares for 180 days, right? That's just so they don't crash the price. But SpaceX added this very unique clause. If the SPCX stock trades 30% above its $135 IPO price, meaning it hits $175.50 for 5 out of 10 consecutive trading days, a trigger fires. An extra 10% of locked-up insider shares immediately flood the market early. And it's not just that single trigger either. If you mentally pin a calendar up on your wall, you're going to see a deliberately staggered release schedule. Instead of one massive, headline-making drop at the end of 6 months, insiders unlock in 7% tranches. We're talking day 70, day 90, day 105, day 120, and day 135. Throw in 2 massive, schedule-dependent earnings cliffs of 20% and 28%, and you have a system designed specifically to diffuse selling pressure across a dozen smaller dates that everyday retail investors just aren't tracking.
This reveals a pretty cruel asymmetry in the market. That day one pop that retail investors and the financial media are all celebrating, that is actually the exact mechanism that triggers the early insider sell-off. The harder the stock runs in the first few weeks, the faster insiders are contractually permitted to dump their shares onto the open market. Retail's victory lap is literally the insider's starting gun.
Now, you might see headlines praising the fact that the founder, Elon Musk, has committed to a 366-day lockup. And yes, for sure, that generates fantastic PR. But what those headlines completely miss is that 83% of all the other insider shares, the venture firms, the early employees, they are going to unlock within the first 6 months. By the time the founder's lockup even begins to lift, the rest of the insiders have already had a full year of carefully timed exit windows to cash out.
All right, Section 4, the passive buying machine. How could the market possibly absorb all that insider supply? Let's direct our focus over to Wall Street, where the index rules were quietly rewritten to provide guaranteed exit liquidity.
So, right before this IPO dropped, NASDAQ adopted 3 specific rule changes that effectively roll out the red carpet for unprofitable tech giants. First, they introduced a 15-day fast entry rule, dropping the standard 3-month waiting period down to just 3 weeks. Second, they completely removed the minimum free float requirement. And third, they introduced a hidden multiplier.
And this hidden multiplier is just staggering. Under these new rules, a company with a free float under 20% is treated as if its float were 3 times larger. So SpaceX is targeting a free float of just around 5%, but the index legally treats that tiny 5% float as if it were a 15% float. This pulls an immense amount of artificial gravitational weight, forcing passive ETFs tracking the NASDAQ 100 to mechanically overbuy the stock. It just floods the market with automated institutional demand. And guess who else is absorbing these shares? Retail buyers. While your standard IPO allocates about 5 to 10% of its initial supply to retail, SpaceX is dumping an unprecedented 30% onto retail buyers. And the CFO of the company openly stated this is because retail buyers have been incredibly, quote, supportive of Elon. How generous is that, right? Rewarding your fandom by letting you hold the bag.
Which brings us to a very powerful quote by portfolio manager George Noble. Your 401k is the exit liquidity. Because of those rewritten NASDAQ rules forcing index funds to automatically buy in, if you hold a U.S. stock index fund in your retirement account, you are mechanically forced to buy SPCX at these peak valuations. You don't even get a vote. The buyers are forced in early, and the insiders are unlocked later to sell into that exact manufactured demand. Okay, Section 5. Your action plan. What do we actually do with all this information? Let's guide this toward a logical, totally non-emotional resolution using the structured facts we've just laid out.
Honestly, the smartest path forward costs you absolutely nothing but patience. Just wait out the 180 days. The market rewards the patient far more reliably than it rewards the early. In 6 months, the staggered insider tranches will have lifted, the artificial forced buying will have completely run its course, and real, concrete earnings reports will finally replace all this speculation. You really don't have to catch the first hour of trading to do well on a great company over the next decade. So, I'll leave you with this final thought. Are you going to let the hype, the news anchors, and that day one pop make your investment decisions? Or will you let the calendar and the mechanical facts do the work? Look, the numbers on the screen are loud, but the calendar is quiet. The habit of looking at IPO structures, the lockups, the float math, the index rules, that is exactly what separates a gamble from a calculated investment. Look at the mechanics before you chase the headlines. Thanks for joining me on this explainer, and keep your focus on the facts.